When people think about investing, the first emotion usually isn't excitement, it's fear. Fear of losing money, fear of making the wrong choice, fear of complexity. And that fear keeps millions of people stuck on the sidelines while inflation quietly eats their savings. Here's the truth. You don't need to take huge risks to start investing. In fact, the smartest investors begin with low-risk strategies that build confidence and compound wealth over time. In this video, I'll share 3 low-risk ways to start investing today, why they work, and how to implement them, even if you're starting with $50. Let's dive in. The biggest misconception about investing. Most beginners think investing means gambling, picking stocks, timing markets, or chasing trends. That's wrong. Investing isn't about luck. It's about systems. And the safest systems are simple, diversified, and automating. Investing isn't gambling. It's building systems that compound quietly. Strategy 1. Low-cost index funds. If you want low risk and long-term growth, start with index funds. These funds track entire markets, like the S&P 500. So you own hundreds of companies in one investment. That means instant diversification and lower risk compared to picking individual stocks. Here's why it works. Historically, there's strong returns, 7 to 10% annually over decades. There's also low fees. Look for expense ratios under 0.1%. There's also no need to time the market. Just automate and hold. Here's how to start. Open a brokerage account or an IRA. Choose a broad market index fund, like VOO or VTI or something similar. Automate contributions weekly or monthly, ideally the same day your paycheck rolls in. Money that automatically goes and you never see, you'll never miss. Skip stock picking. Start with index funds. They win more over time anyway. Strategy 2. Target date funds. If you want investing to be completely hands-off, target date funds are your best friend. These funds automatically adjust your mix of stocks and bonds based on your retirement timeline. It works because there's built-in diversification, automatic rebalancing as you age, and it's perfect for beginners who want simplicity. Here's how to start. First, pick a fund with a date close to your retirement year. For example, a 2070 target date fund. Step 2, invest through your 401k, IRA, or brokerage. And step 3, automate contributions and let the fund do the work. Target date funds are the set it and forget it in investing. Strategy 3, high yield savings and bonds combo. If you're extremely risk averse or just starting out, combine a high yield savings account with government bonds or bond ETFs. This strategy protects your principal while earning modest returns. Here's why it works. It works because FDIC insured savings accounts offer safety and liquidity. Bonds also provide stability and more predictable outcome. It's great for short-term goals or building an emergency buffer before diving deeper into stocks. Here's how you start. First, open a high-yield savings account for your emergency fund. Second, buy US Treasury bonds or a bond ETF like BND for low volatility. And third, automate your transfers monthly. Remember, what you don't see, you won't miss. Safety first, pair high yield savings with bonds for steady growth. The power of automation. All three of these strategies work best when they're automated. Set up recurring contributions so investing happens without even thinking about it. This removes decision fatigue and uses dollar cost averaging to smooth out market volatility. Automation beats timing. Set it and forget it. How much should you start with? Well, start with whatever feels doable. $50 a week or $200 a month, or even 10% of your take-home pay. The amount matters less than the habit. As income grows, remember to increase your contributions every time you get a raise or an unexpected big bonus. Start small, scale fast. Habits compound into freedom. The psychology behind low-risk investing. Low-risk strategies aren't boring. They're powerful because they keep you consistent. The biggest risk isn't market volatility. It's the risk of quitting. These approaches remove fear, build confidence, and let compounding and time do the heavy lifting for you. Remember, the biggest risk isn't volatility, it's quitting. Low-risk strategies keep you in the game. Here's a bonus, the hybrid approach, where it combines all three. Use index funds for long-term growth, add a target date fund for simplicity, and keep a high-yield savings and bond combo for short-term stability. This creates a pretty balanced portfolio that grows steadily while protecting your peace of mind. Here's some common objections and simple answers to help encourage you and keep you motivated. Objection number 1, I don't know enough to start. I need to do some more research. Start with index funds or target date funds. Remember, complexity kills consistency. Objection number 2, I'll wait until the markets calm down. Markets historically never really calm down. Time in the market beats timing the market. Objection 3, I can't invest much, I just don't make a lot. Start with $10. Start with $1. The habit is more important than anything else. Your habits will scale better than your intentions. The safest way to start investing isn't waiting, it's acting. Choose one strategy. Automate your first transfer and let time do the work. Quiet consistency beats loud predictions. If this helped and you want calm, practical finance videos that work in real life, please consider subscribing to the channel. Leave a like. It's free for you and it helps me immensely. Join thousands of people just like you, building freedom one smart decision at a time.